We've been talking about European stocks and equity futures here in the U.S. are higher this morning after last week's volatility and a huge drop. It's because of some new optimism about the efforts to tackle Europe's debt crisis coming out from the Eurozone. Well, joining us now is Bloomberg Best and MF Global Chief Economist Jim O'Sullivan. Jim, great to have you back with us.
Thank you, Betty.
And are the markets getting ahead of themselves, rallying here on some of this talk of some new measures?
Well, it's all talk, of course, at this point. But then again, it was a pretty big drop last week, so it still pales in comparison with last week's drop. I mean, obviously, there's been talk about expanding the FSF, about a TALF in Europe, about the ECB potentially easing again next week. Obviously, other than at the ECB, it's been pretty hard for European officials to really reach agreement on anything quickly. So at this point, for the most part, it is just talk.
Well, out of all of those measures, I mean, what gives you most confidence?
I mean, ultimately, certainly ECB easing would help.
Okay.
As Fed easing in the U.S.
You think that would be the strongest
helped.
signal?
No, but I think ultimately the issue is all about the risk of default in Europe. So it's not really about liquidity per se. It's about the risk of insolvency in terms of the governments themselves, and then in terms of the banks also. So either A, governments taking over the debt, or B, governments doing something to recapitalize the banks. Those will ultimately be the most important for markets.
I was talking with Jack Mulvey earlier from Bank of New York Mellon, and we were discussing this timeline, right, that the G20 officials are saying that they need to have some sort of plan, some sort of solution in the next 6 weeks. I mean, does that sound reasonable to you?
Well, I mean, obviously, if we kept getting declines like last week, then the timetable would have to be moved up.
Okay.
I mean, I think realistically nothing's going to happen quickly. So I think, frankly, if we could get a solution in 6 weeks and this was behind us as an issue, I think most people would take it. But frankly, it's hard to see anything suddenly happening in the next week or two, unless markets really force it.
But Jim, what is a solution? What is a solution per se?
Well, I mean, ultimately, the issue, I think, is questions about whether banks will be able to take the risk of default. So I think markets need to be assured in some way that either the governments are going to step in and pay the bill to some extent, and also that banks are going to be in some position to absorb more of a default than has already happened. So there's just a lot of uncertainty about that right now.
But that sounds like you're pricing in a default in Greece then.
I think most people are pricing it in at this point.
Okay.
And the question, of course, does it expand beyond Greece? I mean, if you could be sure that it was just Greece, then I think the issue would not be as challenging, clearly. But the question is always who's next.
So is the U.S. economy here prepared for that?
Well, if there was what's called a Lehman-type event in Europe, and banks go into another round of major credit crunch, then that inevitably would spill over to us. And at this point, that hasn't happened. For the most part, the U.S. banking system is recovering over the last couple of years. You see banks starting to ease lending standards again for most categories of loans, except for mortgages. And I think the most likely scenario is that ultimately we don't get another major round of credit crunch out of Europe. So I think it's not a big deal for us in the end. But in the meantime, the markets are obviously worried about it, and that worry can become self-fulfilling. Obviously, the equity market has been weakening. That's feeding back into consumer confidence. So even without an actual event in Europe, it is affecting us already.
But even without an event in Europe, though, will we see a recession in Europe?
It looks like they're on the border of recession right now. Obviously, their PMI numbers have dropped just below 50. I think it is quite possible there will be recession-like numbers in Europe over the next couple of months. The European numbers already are weaker than the U.S. numbers.
But would that inevitably drag us into recession?
I don't think, unless it spills over to the whole banking system and the markets. I mean, I think we are at risk here. If the U.S. equity market keeps going down and confidence keeps going down, then the hard numbers in the U.S. will probably follow. So I think it is imperative that the equity market stabilize and confidence starts climbing back, because right now there has been a recession-like drop in the confidence numbers. So far, the hard numbers have held up better. But there is a bit of a disconnect here, and something's got to give.
Why do you think the hard numbers? What do you mean by hard numbers, by the way?
Well, certainly you look at the jobless claims numbers; they've stayed pretty low.
Okay.
I mean, they're not low, but they haven't been shooting up in a recession-like way. The ISM indexes are still above 50. Consumer spending itself has been rising modestly, at least, even as the confidence numbers have clearly fallen pretty sharply. So you look at the broad indicators of growth, and they're still signaling weak but positive numbers.
So you're saying the hard data tells you that we're going to avoid a recession?
That we have so far. There's no guarantee that that'll continue. I mean, our forecast is that will continue, but I would say we have seen a recession-like drop in the confidence numbers. And if confidence continues to drop, and if the equity market continues to fall, then yes, there are lags there. So I think we need the confidence numbers to start climbing back. And I think tomorrow, for instance, we will see a little bit of a rise, at least in the Conference Board confidence number. But we need to see more.
But it sounds as if for confidence, though, I mean, you really need to have the stock market volatility stop
I think so, yes.
Isn't that,
yes,
isn't that key, right?
I mean, in the end, the stock market is as good a leading indicator of the economy as there is. Now, so far, I'd say we've seen a sizable drop in the equity market, but not necessarily one large enough to signal a recession. But you get another 10 or 15% drop in the equity market and confidence drops some more, and obviously the probabilities change.
Okay, Jim, great to have you with us as always. Jim O'Sullivan, Bloomberg Best, also Global Chief Economist at MF Global.